On today's show, 3 questions. Number 1, what's Jay Powell saying these days? Number 2, inflation? How about deflation? Number 3, are you ready for another student loan update? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Taylor.
And I'm Rabih.
Hey, guys.
What's up?
Did I get you, Rabih? I keep you guessing literally every time.
Yeah, you are part.
Yeah. We said we were going to make T-shirts that just says, yeah, you are. It says Rabih ... yeah, you are. I actually want to do that. Okay, this is our final 2 cents before the summit.
Yeah.
It's coming out the Saturday before the summit. Summit is officially next week. It's kind of crazy. And the next 2 cents will be a live 2 cents on stage. So very excited about that.
Who are you doing with, Matt? Who's joining on that? Is that you, Ryan, Rabih?
No, so we're doing 2 episodes next week on stage during registration. We are doing a 2 cents. It's Victoria, Rabih, and me. And then right as that finishes, Ryan and I are going to do a Dentist Money show, like main show episode. So, yeah, we need to find some topics for that probably. Rabih's like, we should probably do something special. And I was like, yeah, let's do it. I don't know what that'll be, but it'll be fun. We'll have fun with it. So, all right, let's jump in. Rabih, I know you have been itching to talk about the Fed's meeting in June and what Jay Powell is saying.
Dude, in my world, it's been very exciting. I know it does not look like that on the outside, but I don't know if
giddy.
you know.
You are giddy.
It's been very exciting in my world. This last week was the most exciting week for the markets in a couple months. Like it's been big, and I can't wait to share this excitement.
You are literally giddy right now. You're so excited, and I love it so much.
Nerd alert.
I was a little late on our trades on blotter email the other day, and Rabih was just on top of me, like, "Look at the volatility. What are you doing? You got
It's like you get your answer in right now."
Rabih,
That's funny.
We don't day trade. You know that, right, Rabih?
Yeah.
We're not. We're just trying to reduce costs.
Yeah.
So let me give you a recap and make you see how this all fits into place and why I'm excited about it. A couple of weeks ago, we were talking about developed countries starting to cut interest rates, which they did. The Bank of Canada and the European Central Bank both cut rates. And those economies were most similar to the US, so we were excited to what the Federal Reserve has to say about rates. We got unemployment numbers last week, and we noticed that the unemployment rate ticked up to 4% for the first time. And we were like, okay, the Federal Reserve is at a pivot point. Given this new data, what are they going to say? And on top of it, this is a June meeting, a quarterly meeting, where they're going to be issuing their summary of economic projections. So they're going to be resetting expectations about the economy, about inflation, about unemployment, and about the path of interest rates. So a lot to unpack. And, the market will have to absorb this information and reflect this in prices. So let me start with the inflation numbers about the CPI that we got Wednesday morning. And we're getting those. They are lagged indicators, so they are for May. And we saw that while the inflation rate was around the 3.3 level, 3.4, which it has been still trending sideways since the beginning of the year, the core inflation rate, which excludes food and energy, actually ticked down from 3.6 to 3.4, which is the first actual movement of inflation numbers to the downside since a meaningful one since the beginning of the year. So we've had 6 months where the economy is very strong, but inflation has been below than the high, but trending sideways, and unemployment a little bit above the low, but also trending sideways, and there has been developments. So with that coming in, we know that the economy is slowing down from the unemployment side. Unemployment side is ticking up. Inflation is making progress to the downside. So we are getting to a place where the economy is now at an equilibrium. What does this mean to interest rates? Should they stay elevated? So let's jump to what Jay Powell said. And I'm quoting right here because I promised you I'll be getting quotes. And he said, quote, "We see today's report as a progress and, as you know, building confidence. But we do not see ourselves as having the confidence that would warrant beginning to loosen policy at that time." So They're very happy with the results. The economy is trending towards the equilibrium that they need. But although those are only a couple of data points, they still want to gather more data points to be confident in their decision. With that, they did not cut interest rates. Interest rates are still at 5.5% for the year. However, we also discussed this a lot before. We started the year with the Federal Reserve saying the expectations for interest rates by the end of the year are 3 rate cuts. And the market didn't buy it at the beginning and overbought it at the end. We had like 6 rate cuts priced in, and then the market priced in 0 at some point. The Federal Reserve, in their summary of economic projection that was issued, now is saying that they only expect 1 rate cut in 2024. And 4 rate cuts, aka, and when we say rate cut, it's like 25 basis points. So, and 4 rate cuts, aka 1% of a cut in 2025. So now we're all thinking about 2025, but only 1 rate cut for 2024. And this has some good implications for it. One, the Fed followed what the market, the wisdom of large numbers are saying. We only need 1 rate cut. The Fed is following them. That's one. Two, the Federal Reserve kind of avoided making interest rate decisions political, because if they do not cut in November, they still have December, which the results would have come already. We know who the president would be at that point, and they can just cut in December and keep the economy outside of politics.
Do you think that's part of their motivation, like for real? Do you think they're truly motivated by trying to keep it separate as much as they can?
They would want. They are an independent organization, because honestly, if he decides to cut interest rates, I don't know, on the October meeting, we would expect the markets to be making all-time highs in November, and everyone's cheering up because mortgages are now cheaper and stocks are now up, etc., etc. Because he's cutting rates independent of a crisis happening, and just cutting rates on their own will inflate financial asset prices.
What's interesting, really quick, Rabih, on that of the whole political thing is, it's probably pretty difficult for them, because no matter what they do, it's going to be deemed political, I would imagine, depending on which side you're on, right? Meaning if they cut in October, one side's going to say, oh, you did it to favor this candidate. If you cut in, I'm not going to name either side, but if you do this in December, oh, you were doing this in favor of the other candidate. So that is an interesting angle you're taking there. That it's like, and if you think about it, no matter what the Fed does, politics are going to probably get wrapped up into it, unfortunately.
Yes, but the more they delay it until after the election, the less of an impact they have. Like, their action has more impact than their inaction.
Totally.
And
that's a good point. Good point.
To not do anything. So, 1 rate cut for the year, but let's see what they think the GDP is going to be like, unemployment is going to be like, and inflation is going to be like. So, start with GDP. What we've been talking about for the last couple of weeks is that the Federal Reserve said that they think 2024, the economy is going to be growing by 2.1%. And on several episodes, we received data where it showed that the Q1 of GDP on an annualized term only grew 1.6%. And then later, after a revision that was 2 weeks ago, they revised it down to 1.3%. So when I say 1.6, this is the annualized number. We divide it by 4. It means the economy grew 0.4% out of a target of 2.1. So you only had 3 remaining quarters to grow the remaining amount to get to 2.1. And we were like, this is above average growth. And this is very bullish. It means the economy in real terms is really growing faster than the 2% target. Well, is this really going to happen? Well, they doubled down. They kept their projection for what they think the growth in GDP is going to be, and they said it's going to be 2.1. So we already have 1.3, which is around 0.35 already locked in. We still have the remaining 0.75 in a sense, 1.75 in a sense, of real growth happening in Q2, 3, and 4, which, just looking at that numbers, like, the economy is doing great from a real GDP perspective. I couldn't stop myself, so I went and looked at data regarding Q2 of GDP to see where we are, and the numbers
just on the weekend, just over the weekend.
Yeah, like, I was itching. So it based on the Federal Reserve's GDP Now tracker, which tells you what they think Q2 is going to be like, it looks like Q2 real GDP growth on an annualized basis is going to be 3.2%. Guys, those are numbers that are surprising economists by how strong the economy has been performing, and all thanks to consumer spending, because the other factors of the economy haven't been contributing as much as consumer spending has. So that is the GDP conversation. Unemployment rate also unchanged at 4%. So they are at target. They just hit their target in terms of what unemployment rate is. They want it to remain as is until the end of the year. If we start seeing data from now till December where the job market is slowing down and unemployment is ticking up above 4%, the conversations might start showing up around, oh, will they cut interest rates faster? Just because they thought it'll stay 4% until the end of the year, but it is now not. So that is something that we will be like looking at and covering as it comes. And in terms of their PCE inflation, which is their preferred number of inflation, right now it's at 2.7. They think by the end of the year it's going to be 2.6. Their estimates back in March is that it's going to drop to 2.7. So they think inflation is going to be sticking a little bit for longer, but where it is right now. So, which is kind of fine. And the reason I'm saying kind of fine, and I'm going to kind of conclude everything I went through right now.
In conclusion,
The fact that we've got a strong economy that is able to endure, the slowing of the labor market by a higher unemployment rate, and also endure above trend inflation around 2.6% rather than their target of 2%, has been perceived positively by the market. And that's why we've been seeing equity prices hitting all-time highs throughout the last 2 weeks. Very, very bullish indicators, whether they were economic or from capital markets.
What's so interesting about this, first of all, thank you, Rabih, as always. Seriously incredible to get the updates every week. What I find so interesting, and this is not to go down this road too much, just more of a comment. It's just so, and we talked about this a little bit before, Rabih, before we went on, right? It's so interesting how sentiment just doesn't match reality.
Yeah.
Like, it just feels people, like, by every objective measure, the economy is so strong. But you talk to people and it's like, it could not be more the opposite, the sentiment side. And again, we've got ideas and theories around this, but I guess the only word I can use is it's pretty fascinating to me that there's such a gap right now of reality versus the overall sentiment.
There is a gap of reality. We know that inflation actually messes with our expectations, and the fact that we experienced inflation the last 2 years, people feel that they can't really make it. But in real terms, especially if you've been invested in financial assets, and we're talking real estate and stocks, in real terms, you've never been richer, American consumer.
Yep.
So it is fascinating.
You people out there.
Yeah, never
it
been
is fascinating. Taylor, any thoughts from you on any of this?
Well, my only thoughts were, you were mentioning perception versus reality. I just feel like election years are just crazy. Like I'm having clients ask about elections, but I'm also having just like friends and neighbors asking about the election and what they think it's going to happen with the stock market. And I love, with our clients, we put out something, was that a month ago? We did a little video about investing during election years. And despite everyone always losing their minds every 4 years when there's an election year, if you look at the average return of the US market, it's an 11.5% rate of return in election year. The average election year return in that year. So it actually performs better than the long-term average of the stock market. You're getting about 1.5% or 1.5% better in the stock market, but you wouldn't know that talking to people, because every single year during an election year, it is just crazy how people just become negative and worried and just pessimistic about everything. And despite that, the market over the long term has actually done better in those pessimistic years.
Yeah, it's so true. And again, this could be a whole other show. We should talk about this. There's a lot to talk about here. We could do a series on why we as humans favor negativity. But anyway, I find it fascinating. So, Rabih, any final words on the Fed or anything that you just hit?
No. more of like stay tuned. I'm now excited because we're starting from a really good position where if nothing changes from here on, we would expect better returns in the stock market. The outlook is bullish and positive. I would just be sitting there and waiting to interpret news as they come and see whether this is going to deviate us away from the newly set narrative that things are looking really good.
Yeah. Okay. That's awesome. Okay, guys. So, you know how you like to, on weekends, put on like a nice fresh suit, maybe some outerwear, maybe put together like a basket of like, grab a bushel of apples and make a couple ham and cheese
What?
sandwiches. Maybe put some potatoes in there, maybe some citrus fruits.
Where are you going with this?
Maybe Rabih, you grab your lady friend, and Taylor, you grab your wife, and she's wearing some nice outerwear, and you hop in your used car and you drive to a park and you have a picnic. Like, you know how you guys love doing that?
Sure.
Yeah. What's amazing about this is
consumer goods.
Yeah, this just got cheaper. That activity that you guys love just got cheaper.
Oh.
And Rabih's like, okay. So sorry for my lame intro there. But we talk so much about inflation, and it's been such a dominant topic. What's interesting, and the what I wanted to talk about and share, and have you guys comment on, is what this article I found was talking about these micro pockets of deflation. And keep in mind, again, Rabih, you pointed out with your discussion around your highlight of inflation, a lot of this is delayed. So this is coming from May. So we don't have the June numbers yet, but just these micro pockets of things that are actually getting cheaper. And Rabih, you already hit like core PCE coming down. But I thought the reason I got so specific, and I know you guys love doing those things, some key areas that we're seeing some like relatively significant deflation. So randomly enough, apples, and if we're just hitting the grocery area, Taylor, you're going to love one here coming up. Apples have deflated in real terms by 13%. And you know what they say about apples, one a day, it keeps the doctor away. Ham, cheese, potatoes. That's why I mentioned citrus fruit. So like literally like some key essentials for going on a picnic. You know what I'm saying? Taylor, you're going to love this. Fresh milk.
Oh,
fresh milk is down 2%.
I like a tall glass of milk in the morning.
You do only like 4 times a day. Yeah. And then, so like telephone hardware, calculators down 12%. We don't have to go through the whole list. Cars, new and used, are down. Again, Taylor, you're going to love this. Men's suits down over 5%.
That's honestly shocking to me because cars don't feel like they've come down.
Yeah.
Is that a recent one?
This is as of May. They're saying used cars and trucks down 9%. They're saying new cars. Where was the new cars? I think it's not as much. New cars down 1.4%.
Yeah, I wonder if that's a regression to the mean because cars there for a while really took off.
I'm sure that's a good point. I mean, we're talking about coming down from the wild highs post-COVID, right? So we got to keep that in context. But again, it still bears kind of like focusing on, I'm just saying like prices are coming down in a lot of these key areas. Airline fares, so plane travel's down. Health insurance, yeah, Taylor loves that one. Health insurance down over almost 8%. Toys, my kids, I'm going to talk to my kids about this tonight. It's like, hey kids, toys are down, or maybe I won't tell them that. Anyway, I just thought it was worthy kind of discussing for a couple minutes of just these pockets of inflation, or these pockets, I should say, of sort of deflation in a lot of key areas of the economy. And just, again, kind of closing this gap between perception and reality that I think you talk to people, you see the headlines, it's inflation, things are just so expensive. I think part of that is probably because housing is still so crazy. And that's such a huge part of the economy, and people think about, especially like our peer groups and people listeners of the show and things like that, probably around that age. So I totally get that. But one thing I wanted to mention, Rabih, you kind of hit this, but I wanted to just emphasize, let's see, where was that, Rabih? I was telling you, So overall physical good prices, excluding food and energy, so this is core PCE, have deflated in all but 1 month since May 2023. So of May of last year. So for example, according to the Bureau of Labor Statistics, goods prices are down 1.7% over the past year. So Rabih, I know you probably have some comments on this, but I just wanted to highlight some of these key areas of things that, goods are actually, a lot of key areas are actually down.
Yes, goods are down. The stubborn one is shelter, as you mentioned, and we still have services that are actually unable to control yet. But it's all trending in the same direction. And I actually, when you were mentioning it and when you said the micro pockets, I love the analogy, because when inflation was starting to creep up back in 2021, we were talking about micro pockets of inflation. The Ukraine-Russian war started. There was an inflation related to gas prices and grains like wheat. And we were saying, oh, as long as it remains in that industry where itself and there's no contagious effect to the rest of the economy, inflation is not a problem. And then suddenly food products got more expensive. And then we noticed that the labor market did not react in the same manner of time. And then were supply chain disruptions, which made those micro pockets all like pop and then make the whole economy inflate. And this is the natural way of how a slowdown shows up. You'll have micro pockets of deflation, and then when it becomes big enough, you would see an economic slowdown, and if it's severe enough, it's a recession, right? But it depends to where you're falling to. If you're falling back to the baseline, that's great. If you're falling from the baseline towards a slowdown, that is worrisome. So it depends on where your starting position is. And I think what you mentioned in terms, although honestly, putting on a suit in a 90-degree weather and going on a picnic might be fun,
Not really.
But the narrative and like the data that you presented matches the narrative that yes, we are trending towards the equilibrium that they want, and the equilibrium does not sustain a continuous inflationary regime on goods and services.
Well, we do know that throughout this process over the last few years, that nothing makes people more angry than eggs being more expensive. That was a real point. I if those hadn't come down, and actually I don't see them on the list, so people are maybe still freaking out about eggs. But one thing I wanted to point out, Taylor, I know this is big for you. Laundry equipment is down almost 9%. So I know that's probably a big thing for you. But Taylor, any thoughts on this?
No, I mean, that's just, it's a little bit of positivity after, years of negativity around inflation. So I mean, not much to add there other than it's about time.
Yeah. It's about time. Yeah. I mean, and that's a good point, Taylor. We talk about like, navigating the noise. Truly what we're trying to do with this is not to bring like unrealistic positivity, but hopefully through these discussions, bring some level of reality of saying like, hey, the news media will always try to do everything they possibly can to get clicks. Negativity gets more clicks. What's the whole thing, Rabih? VIX get clicks. Like when the VIX is up, they get more clicks. Like when volatility, when things are going crazy, and if it's not, they're going to try to flip it to be more negative. And so again, we're trying to just bring some reality and saying, look, it is not as bad as you see out there. The reality is actually quite good right now if you look at the objective numbers. So, okay, moving on, we'll finish up with another student loan update. Taylor, you said there's some key things we wanted to hit on this.
Yeah, I feel like every time I come on,
as our resident student loan expert.
Yeah, that's what we're saying. Really, more than anything, I think there's one big action item that I'd recommend for everyone out there that's on income-driven repayment plans with your student loans. And that one action item is just make sure your contact information is up to date with your servicer. Right? If you haven't done that, if you haven't logged into your servicer and you haven't updated your contact info, please do, because there is a lot happening and things are changing constantly. So 2 examples from actual clients who have received letters from their servicers, from the IRS. There's something happening right now called the IDR account adjustment. It was previously known as the IDR waiver. So for years and years, and I brought this up on previous podcasts, but up until May of 2021, only 32 individuals had ever achieved forgiveness on income-driven repayment plans. Out of the millions and millions of people on these plans, only 32 people had ever achieved it.
Which is wild. Yeah.
Which is absolutely insane, right?
Yeah.
That's really one of the...
I think they're in a Facebook group, actually. Those 32.
I don't know how they found them. I don't know how they were like, yeah, it's 30.
Yeah.
But Biden had, when he came out with his student loan, platform, there were three different initiatives that he wanted to accomplish. One was immediate forgiveness, and that's what that $10,000 proposed loan forgiveness was going to be. That was the SAVE plan. Number two was to fix the payments on previous income-driven repayment plans. And then number three was to make education cheaper. Now, I don't know what he's going to do with number three. I don't know how he plans on accomplishing that. I'm like, good luck. But he has delivered somewhat on 1 and 2, right? SAVE plan has been saving people thousands of dollars a month in interest subsidies. And
probably more than just the straight up forgiveness. Yeah.
Way more. But number two is they have been doing a concerted effort since the beginning of this year, and they're going to go through September of this year. And they have a full team that's going through past payments for people that have been on income-driven repayment plans. And for whatever reason, over the last 25 plus years, you've had to jump through hoops to get this forgiveness or to get credit for your plans. And so they've been going through and they've been granting this and they've been granting this. And as of May 15th of this year, they for 996,000 longtime borrowers achieved $49 billion of loan forgiveness.
Whoa. Okay.
There's been a huge thing. There's been we've gone from 32 to
a million.
A lot more than 32.
Yeah.
Right? And there's actual people going through your accounts and granting forgiveness based on past years of credit. Now, the problem with this is they're sending out information and they're sending out notices and letters saying, hey, we're doing this. Do you want to opt in? So my client, thankfully enough, sent me this letter and forwarded it to me and said, hey, I got this final notice of some IDR account adjustment. Is this real? Is this fraud? And I was like, yes, it is real. Please opt in. Right. So you're getting so much communication right now that you may not be paying attention to it. But there's some really, really important things that are literally saving people millions of dollars and in aggregate billions of dollars across the country. So
got it.
Make sure that your information is up to date because there's active things happening within your student loan income-driven repayment plans.
Got it. So you're saying, Taylor, which makes sense. You're saying that there's people that are closer to forgiveness than maybe they even know, and they're making these adjustments based on past years that because it's been such a mess over the years that they're like going back and making sure they're getting proper credit, which is actually getting them to a place of forgiveness where they're going from 32 to a million people. So this is actually legitimately working.
Yes.
Like significantly.
As of May of this year, $49.2 billion were forgiven.
Wow. That's wild.
So
that's crazy.
This is where I would say, if you're not paying attention to it, just try to a little bit more. There's communication that's happening specifically this year that's really, really important. The other thing that has happened is I had a client send me a letter and forward me a letter and said, is this legit? And they were scheduled to have their recertification month this October. And for whatever reason, their servicer's behind and they gave them a notice that they're actually pushing that date back until October of 2025.
Yeah, but I'm seeing this a bunch too.
So it's happening a lot right now. So if you know your recertification month or not, there's a lot of these that are actually being pushed off even further into 2025. And so just another reason why you need to make sure your contact information is up to date, because there's things happening with your student loans. And if you have old data or old information out there, you're probably missing out on it.
Yeah. I think the key here I'm hearing from you too is pay attention. There's a lot of communication, like you said, coming out coming at you. I've seen the same thing. Clients sending me stuff saying recertifications being pushed off, which has helped them immensely because I have a bunch of clients who have the last certification date they have was from like COVID or during those times when their income looked way, way worse. And so their payment, they're on save and their payment's significant, like it's so low and they're saving thousands of dollars a month.
This particular client is an endodontist and they have $900,000 in student loans.
Ooh, okay,
So
okay.
their interest owed would be $5,000 a month on the standard repayment plan.
So every month they're saving 5 Gs.
Yes, because of their, because of COVID, they're still at a zero payment and their payment has been kicked off till October of 2025. So they're getting $5,000 a month in interest subsidy that's extended.
Wow. That's amazing.
So
Good
it's
for them.
a little bit more than that one-time $10,000 loan, for goodness sake.
Yeah, I was going to say, somehow everyone freaked out about the $10,000 and then they went with Save Plan. And now it's like, okay, well, we're going to just save, I don't know, people 10x more than that. So, wow, that's amazing. Okay. So pay attention to the communication coming, forward stuff to your advisor. Always ask. Don't just assume that it's fraud or that it's not real. Maybe assume that it is real. Ask more questions. And like you said, Taylor, have your contact information up to date as much as possible.
I love that forward it to your advisor, like talk to someone. I mean, I don't know if you should assume that everything is real. That's some scary advice, right?
No, sorry. I'm not saying assume everything's real. Assume, like, ask the question before you just assume it's not real.
Yeah.
I should say. Not assume it's real, like take action on it. But they're asking the question, like, is this real? Like, I think at least ask that. As opposed to like, definitely don't assume everything is real. That is definitely not it. Thank you for that correction. Okay, anything else, Taylor or Rabih? Any other final words?
I don't have student loans, but I kind of wish I do just because I know Taylor.
I know.
He knows so much. It's fascinating.
I know. It's pretty cool. We've got Taylor and Jake, our resident student loan experts in-house, to the point where literally most of the questions that come in, I'm just like, I'm going to go to Taylor and Jake because they've studied this so well. So if you have questions, I guess that's a great segue, Rabih. If you've got questions on this, student loans, let us know, or really anything in your life, and you want to talk to us, we would love to talk to you. We'd love to hear your story. We talk to hundreds of dentists every single year. Again, it could be anything from just get some questions answered. We'll send you on your way, point you in the right direction, or, understand how you can work with us. We love talking to dentists. So if you have any interest in that, we would love to talk to you. You can go to dentistadvisors.com, click on the yellow book free consultation button, and we'd love to talk to you. Again, this will be our final show before the summit next week. We're looking forward to it, guys, in Park City. We will see you there live on stage. That is our 2 cents. Everyone, have a great weekend. Bye-bye.